and then plowing into to the paper markets, which are rigged. And everybody's like, well, why should I invest in a rigged market? That's why you should invest in a rigged market, because there's a huge arbitrage that happens in these times. And then you can buy, you can make a huge profit on paper, sell, and buy the physical. You can buy way more physical if you do that. And I think we hit the peak for the petrodollar system in April 2020. I don't know if you remember when oil futures hit negative $42 a barrel. To me, that was the end of the petrodollar system.
Ladies and gentlemen, gold has plummeted. Silver has broken through the floor. And we have the man, the myth, the legend, Lior Gantz, to tell us what's going on. We'll be right back.
One stacker on a journey to find silver. International Stacker.
What's up, guys? International Stacker here. We have a man, a myth, a legend in the house today. But first, I'm going to say thank you for joining. Please subscribe, smash that like button, and we're going to get right into it. We have Lior Gantz, who is the owner of Gold Standard Media and huge in the community. You might have seen him on other channels like Silver Dragons, Yankee, both my friends, 2 is 1 Gold, Gold and Silver Pros, among many others. He is extremely popular, and one of my favorite parts, he owns 7 figures in physical metals and mining stocks. Ladies and gentlemen, Mr. Gantz, welcome to the channel. How are you doing today, sir?
Thank you very much for having me. Doing very well.
So why don't you just take a minute and tell us a little bit about yourself?
So my story with regards to finances and whatnot started when I was 13. Actually, my dad's business went under, and he literally told me, "Look, if you want to have a good time, date girls, do anything you want, you need your own gig." And I started like posting, babysitter postages on all the electrical posts in my neighborhood, and started babysitting. And I accumulated savings from doing that, and then I upsold all these parents to let me tutor their kids in basketball and whatnot. By the time I'm 16, I have like 20K saved up, and the banker's like, "Look, you come in here, you deposit money. Why don't you let the money work for you?" I'm like 16 years old. This is June of 2000, right after the dot-com bubble started to burst. And I was like, "Okay, what should I do?" He says, "Get your parents here because you're a minor. They need to sign a waiver, and then you can start trading equities." At that time, it was like mutual funds. You can start trading mutual funds. And so I did that. My parents were, it's your money, you earned it, etc. And that's how I got into investing. He literally, this banker told me, what you do, and this is like early days for Amazon. He says, you go and you order a book from Warren Buffett and a book from Peter Lynch. And that's how I was the kid in high school where, there's the history book, and then inside of it, there's like a Warren Buffett book or a Peter Lynch book. And I'm learning all about stocks and the stock market, etc. And then my dad's second go around also goes bust when I was like 18 or 19. So now I know that like there's no parachute, there's no inheritance, no nothing, on my own. And then I started looking at businesses. So not only investing, but now entrepreneur. That's how I got into building businesses. And in 2008, that's when it sparked for me for gold and silver. That's when I came to America, started buying real estate on the cheap, right after the crash. And I went to a Barnes and Nobles, and I was like, I need to read, anything that's from Robert Kiyosaki. And in Israel, all the books are not here. So I went to the store and started, going through them. And then I see a gold silver guide from Mike Maloney, obviously one of the most famous books for gold and silver.
Oh yeah.
And that's how I started buying. Literally, I remember I started buying. I shipped it to my hotel, and then I was like, okay, what do I do with it now? Like a huge box, weighs a ton. And then I started looking into storage, and I ended up going to the mail. You have to duct tape the whole thing, send it to, and that's how I got into to gold and silver. But the whole financial crisis and the aftermath of it, I really realized when I was like 30, 31, the man, what I do when I read like 3 or 4 books a month on investing and entrepreneur, that's not normal. In my world, I was like, obviously everyone does that on their spare time, but I realized that financial education is a real void. And that's how I launched wealthresearchgroup.com. It's as a free financial newsletter, because I was like, okay, if I'm reading all this and nobody else is, or very few people are, because of constraints and other obligations that they have, if I can condense everything 3 times a week into like a 5-6 minute article, I think there's value in that, and I can share that, and it helps me to kind of summarize everything that I do and I read and I think about into something that other people can understand. So I guess that's kind of my story and how it developed from stock market to real estate to precious metals and just being a full-time investor and entrepreneur.
That's awesome. It sounds like you're a businessman from the start, and then you had 20K at 16. If only you had put it all in Amazon stock. Oh, no.
Exactly.
So
we wouldn't have this conversation probably.
Yeah, there you go. So, a lot's been going on in the market. So like, before should I even say the word COVID? Am I going to get banned? But the beer flu, I guess, the scourge crossing. So before that, silver was kind of, I think it was in the 16s, 17s, everyone was stacking. Then I remember COVID started, and I actually issued a warning to my viewers like, hey, keep on stacking, but make sure you have some emergency cash. If you don't have emergency cash right now, because things are going to get crazy, stop buying metals, get some emergency cash, although I'm not a financial advisor, but so you can take care of yourself and family, because things were so unpredictable. So then we saw silver and gold kind of shoot up to kind of new highs, or at least, new highs for the time or the period we're in. But then recently we saw a huge sell-off, and some even call it a crash or a flash crash of gold, and silver is affected too. Like, what's your thoughts on that and what happened?
So with March of 2020, you saw very similarly to what happened in 2008, when but it was worse. Okay, so 2008, Wall Street thinks the financial system, the banking system, is teetering on the edge, and there's no precedence for bailouts. So literally, they're thinking the world is coming to an end. And that's why it was so brutal, right? 47% for the stock market down, and gold collapsing, silver collapsing by like 60%, because in those days, it was unfathomable that the government would step in, that central banks would step, that somebody would bail out the private sector. And so a huge sell-off. What happens? Anything that you can imagine with margin calls, you have to hedge with liquidating your silver, your gold, anything else, because you have to liquidate and capitalize your brokerage account. So this is very similar to what happened right now. But right now, what was the problem? Did we sell off 35% because of a healthcare crisis? Absolutely not. It had nothing to do with the healthcare crisis. The problem that Wall Street started to price in, and it caused, you remember the circuit breaker week, right? Like every 15 minutes, it was nuts. Why? What's the real reason that the market panicked so badly? Well, our world works on a global principle called just on time, and supply chains move around the planet in a way that took like 30 to 40 years to perfect. And so that's what closed. Globalization stopped altogether, and that is introducing a tremendous uncertainty to the markets. Then you add to that the healthcare crisis, and that's what happened. But the central banks just literally, they just came in real fast, because in my opinion, if they waited another 2 or 3 weeks, it would have been between 60 and 80% that you would have seen the stock market go down. It would have been like Great Depression type.
Right.
And so they came in at first, they said, we're slashing interest rates to 0. Did nothing. Nobody cared.
I know, that's crazy.
It's only when they said, look, do you see the Wilshire 5000? Do you see all these penny stocks and junk bonds? We are buying, we are guaranteeing, like literally the whole economy. And that's when the markets bottomed and started growing up. So gold and silver sold off, not because they're not great or anything has changed with them. No, for 5,000 years, they've done the same thing, right? They're an alternative currency that's outside of the government's hands, and they're internationally, accepted. The whole thing. Everybody knows the reasons you should own gold and silver on this on your channel. But then when you flip it around, here's what's going on. You got the COMEX, which is a paper futures derivatives. It has nothing to do with real world demand for physical silver, and you see that thing go into $12 an ounce. While if you want to buy, Silver Eagles, you're paying 30 or 40 or 45 an ounce. So you got these two markets, and that's the opportunity that arises in these types of situations. Because the smart thing to do, obviously, is to start tapping out of your physical. You can buy later, right? And then plowing into to the paper markets, which are rigged. And everybody's like, well, why should I invest in a rigged market? That's why you should invest in a rigged market, because there's a huge arbitrage that happens in these times. And then you can buy, you can make a huge profit on paper, sell, and buy the physical. You can buy way more physical if you do that, or not even sell any physical, but just take advantage of the fact that the paper price is not the real price. And so at the first innings, when the economy is recovering, when it's booming, you are literally in a situation where gold and silver have a clear runway for takeoff, because the Fed is not going to taper. It's not going to stop. It's not going to put brakes on. It's allowing everything to run wild. And that's why you saw July being the best, July 2020, that is, being the best month for silver of all times, and why you saw a new all-time high in US dollar terms for gold exactly 1 year ago on August 6th, 2020. It's because there's nothing to stop them. It's all price discovery on the way up. But then the market reaches a point where it starts to price in what's next. And what is next? Well, think about like a Formula One car, right? And think about putting a lot of fuel in it. But now it's halfway through the race and it's almost empty of fuel. It will run much faster, right? Then think about just adding turbo to that. Now the tires are gonna have a problem. The engine might have a problem. You need to start dialing down. And that's what the market thought. It thought, man, we've pumped so much liquidity into the markets. We've done so much. We need to quiet this down. When the market starts to anticipate that, that's really bad for gold and silver, really bad, because that uncertainty of how much tapering there will there be interest rate hikes, and all of that, it's like 2011, 2012, 2013. Remember, it's just never ending. There's just a lot of selling in gold and silver in that kind of environment. And that's the environment you find yourself in right now. The trend is down, obviously, right? For 1 year, we've been trending down in both. Not even a global silver squeeze in January could help silver, on the COMEX rise above 30 an ounce. And by the way, if you go to our website, to wealthresearch.com/squeeze and /COMEX, I put together like 2 special reports on exactly this, but more in depth. Like, so you can understand what's going on behind the scenes, why it's very hard to squeeze silver, and why the COMEX is rigged, how these things happen. So that's for your viewers, and they can check that out and download that for free. Okay, so that's the environment we're in. If you go back and look at other times that are similar to this, gold and silver actually bottom the day that the Fed announces that they're raising rates, because then the market starts to price in, okay, well, now they've raised rates. That means in about 1.5 to 2 years, they're starting to cut them again. And so you get into this whole new cycle. The problem that most investors have when they come into precious metals is that they believe that gold is an inflation hedge, and it's not. Gold doesn't correlate with inflation. If you plot the CPI and gold, they rarely do plot each other on the way up, on the way down. Gold correlates to what's called real interest rates, and real interest rates is the deduction between bond yields and inflation. In other words, if bond yields, if the 10-year bond right now is 1.3% and CPI is about 3%, then you're in an environment where real interest rates are about minus 1.2, 1.4%, depending on which bond yield you use, the 10-year, the 5-year, etc. So you are in an environment where it's very favorable for gold. That's why gold is about 1,800 and not 1,200 like it was just 2 years ago. So you're in a very good environment for gold. But if the markets are anticipating that this negative 1.2% is closing, is gapping towards the zero again, then you're going to see sell-offs. A lot of algorithms are going to say, are programmed to where at -1 or less, they just sell off and go other places. So that's important to understand. It's that deduction between bond yields and inflation, which really drives gold. And on August 6, 2020, negative rates peaked. That was the lowest real yields, was minus 1.4%, and then start creeping up. So gold starts selling off. And so what is coming next is going to determine if gold is going to 2,400 or to 1,600, 1,500. And that is that correlation. Inflation is still very high, but if the Fed is going to raise rates, that's going to change this dynamic. In my opinion, because of what we just saw with the resurgence of mask mandates and other restrictions, the Fed might not be as quick to taper and raise rates as the market thinks, and that's really good for gold because inflation is going to keep going up while bond yields are not. And I think that's what you saw with the flash crash. The flash crash happened because of the jobs report, which was amazing. And the Fed literally said, if the jobs report is over 900,000 jobs, which it was, then we're going to taper if it's going to be 2 months in a row. So July being the first, if it happens in August, then in September, they're going to announce that they're tapering. And tapering means that in 18 months, they're going to start raising rates. So that's why gold sold off. Literally, there are algorithms just engineered to sell if the jobs market is over 900,000 jobs. And then what's funny is that their algorithms, they're just set to a level, right? If gold hits 1750, they sell. So it exacerbates that flash crash because you got all sorts of softwares that happen at the same time. That's why on Monday, after that huge crash, our newsletter, I issued an alert. Look, if you understand what's happening right now, that this was all a huge algorithm plot by the COMEX, then I suggest you accumulate. And so you saw a huge rebound on the way back. So if you're asking me like big picture, what's going on? I think what's going to happen in September is going to determine how to play gold. And I think with silver, it's much more situation where silver is so much above where the mining cost is. So to mine silver, it's like $13 or $14 an ounce, and silver is about 26 an ounce. It trades at a huge premium to its mining cost, and that introduces new miners to want to bring supply to the market. And so if there's no mania, I would say gold is probably going to perform better than silver. Now, if the Fed is going to say, look, we've decided not to raise rates, that is going to really help silver because in my opinion, silver right now is the more overvalued of the two. I know that most people think silver should be 50 and over, etc. I believe that can happen if we are in a mania, and I don't think we are in a mania right now. I do think that on June 28th, with Basel III, we saw a real change to the dynamics of the gold silver industry, but it's going to take a while until this starts getting priced in.
So you think Basel III was a thing, or so you don't think it was a nothing burger? You think it's going to take some time for us to see the effects of that?
So good question. Basel III it's not new, right? It's been known for many years. But what it does is it does two things. It basically solidifies gold as a tier one asset. And the only other two tier one assets are, treasuries, US treasuries, that is, and the US dollar. And so it makes it so that for the banking system and for the bullion banks, now they have other alternatives that they need to look at when it comes to their reserves. But it's not happening in a vacuum. The whole world is de-globalizing right now. Supply chains are becoming local. So, for example, if you live in Chicago, New York, Houston, LA, the big hubs in the United States, you will start seeing in the next 2, 3, 4 years, just let's say 90 minutes outside of the cities, you will start seeing manufacturing hubs that are erected and are starting to supply all the needs for the city without this coming from China or other.
Well, especially because COVID, because we saw how fragile everything was, right?
Exactly. That is the catalyst for that. So we are seeing the end of globalization. And why is the dollar so important? It's important because of globalization. But if we are de-globalizing, if we are nationalizing, if every country, Sweden, their own thing, Australia, their own thing, Europe, their own thing, every country has their own agenda and their own way of dealing with this crisis. Have you seen a G7 meeting on how to solve a global crisis? Wouldn't that be like the most basic thing in a global world, to have all the leaders of the world, sit down and, how are we going to do the where are we going to put, plans for the vaccines, for nothing. It's just finger pointing. And so the world is de-globalizing. I think we hit the peak for the petrodollar system in April 2020. I don't know if you remember when oil futures hit negative $42 a barrel.
Yeah, that was nuts. That was
and
crazy.
So that, to me, that was the end of the petrodollar system.
Okay.
Right? The dollar is backed by oil. Right. And if oil is if it's such an issue that you need to pay other people to take that delivery from you, and then you got the whole Green New Deal, which makes oil politically incorrect, then you're moving into a whole new world and you're de-dollarizing. And in a de-dollarizing world, there's a very good catalyst for governments, for central banks, for bullion banks to own gold. And then you have Basel III happening. This is all a really good backdrop for gold. It creates a lot of demand that's not from just retail. So if you go to our website, for example, to wealthresearchgroup.com/Basel, BASEL, like the city in Switzerland, where the BIS, the Bank of International Settlements, is headquartered at, and that's where they came up with this idea. You'll see how this transpired and what this means for gold. Now, does it mean the end of rigging and manipulation? Absolutely not. It doesn't mean that at all. But it means that there's more demand from institutional money, and that makes gold much less volatile to these types of huge crashes. Because here's the thing: you saw a huge crash, and where's gold right now? It's almost at 1,800 again. Not even a week has gone by, because bullion banks look at this and they say to themselves, well, okay, I have a new tier one asset that I can buy. I own no gold today. I should own gold now after a huge flash crash. So there's a new demand that comes in there. You have to remember, at the end of the day, all gold, every ounce that has ever been mined, and it's not in jewelry form, is sitting out there. So the price of gold is not dictated by a supply demand crunch that much. It's really dictated by how much negative interest rates impact institutions and individuals to own gold over cash.
Right. So, and it was funny while you're talking about the end of the petrodollar, I'm like, another nail in the coffin. Remember Mike Maloney always another nail in the coffin. So are you more bullish than on gold or silver? I feel like you're more bullish on gold.
I'm always more bullish on gold as a long-term investment. And I don't need to speculate on that. Like history, as we're doing this interview, it's funny. We are doing this interview. You do realize we are doing this interview on the day that Nixon closed the Goldwyn deal 50 years ago.
Shut up, is it today? Oh my gosh, that's
the 15th. Well, we're doing this on the 14th, but I assume this will air on the 15th or something. The 15th of August, 1971, Nixon stopped the speculators from devaluing the dollar by taking it off the gold standard and taking gold from 35 an ounce to like the 2,000. So, if you look at the past 50 years in the fiat monetary system, gold is trading right now at an all-time high in 74 fiat currencies around the world. It's not trading at an all-time high in US dollars, but if you live in most other countries, owning gold has been an unbelievable idea. Owning gold in the United States has been an unbelievable idea. In fact, I told a friend of mine this. I was like, look, if I was a Berkshire Hathaway shareholder, every meeting I would have sent a letter to Warren and Charlie, explain to me why you don't take that huge cash hoard and at least a third of it put in gold and silver. Because if they've done that in the last 30 years, Berkshire wouldn't be a small 600, 700 billion company. They would be as big as Apple. They would be $1 trillion company. Because they have missed the boat with gold. So, gold accumulates at about 6.6% a year under the fiat monetary system, whereas silver accumulates at about 3.3% a year, so half. So on a long-term basis, if somebody like me, I'm 37, if I'm thinking, what should I own for the next 30 years as a negative rates hedge, it should be gold. But if you're asking me on the short term, when there's bursts, what should I do? Well, obviously silver, because in March 2020, when I see on Amazon and when I call like all the big dealers in the United States, and they'll tell me, if you want to buy physical, it's 40, 42, 45 an ounce for Silver Eagle, and I can buy it on the COMEX for $12, then obviously as a trade, I will either buy, silver on the, through the SLV or the PSLV, or I would do silver options, or I would go into the silver miners because they're absolutely rigged and manipulated to the downside. And I can see that clearly because there's two markets. And so silver to me is more of a trade. It's more of something that I like to get in when it's absolutely depressed and get out of later, and then switch that into gold, into more gold. You talked about like emergency cash. My strategy was basically to calculate how much my family unit burns on a given month. So my lifestyle burn rate, and then multiply that by 2 years, so 24 months, and convert that fiat currency into gold. That was my original strategy when I came into precious metals. I want to have a 2-year duffel bag, if you will, of gold, because if there's a slowdown, if there's a real recession, if something happens, and the income dries up, anything else, a real big recession where the central banks can't bail it out and nothing works, it's a real reset, right? On the bell curve, that's not, that is on the fringes. This is not like I'm predicting hyperinflation like all these other people on YouTube. I'm saying that it does not, I don't see the downside in looking at that bell curve and saying, look, on the fringe here, there is a potential for a real reset. And therefore, I will take 2 years worth of savings and convert them into gold. I do see the downside of taking everything, all of your money and moving it into gold. I do see a problem with that because over the long term, it's not proven itself to be the best way to build wealth. But 2 years worth of savings, heck, why not? It's much better than storing those 2 years of saving in fiat currencies, obviously, right? So I don't see any downside to owning gold. I do not understand. If I speak with somebody who doesn't own gold, I ask, are you too lazy to research it? What's the problem? Because where's the downside?
Right.
Where is it? There isn't.
Yeah.
There isn't a downside. With silver, I do see more of a downside. It can stay cheaper and undervalued and depressed for way longer than gold can. The reason being not because it's not as good. It's because it's demonetized on the central bank and government level. If silver was monetized again, it will probably be $50 an ounce overnight because it's such a small market and governments and central banks will start buying it. It's only because government central banks buy gold that it has that better premium and it's not depressed all the time and obviously manipulated as much as silver is.
Now, what do you think about the one thing I do like more about silver than gold is one thing you kind of hit is gold. Every single ounce is still above the ground, right? But silver, as it's consumed, put on electronics, it goes to the landfill, people are having to mine to get more. So my thought with silver is, there's going to be huge demands in the future as we get more green technologies, more EVs, more machinery that needs silver. Side note, I think in the future, they might actually start to mine landfills, dumps for metals that have been disposed of years and years. But do you think that has maybe another, like, here's what I'm saying. I get what you're saying about silver and it's volatile and it can be held and depressed for a long time. But I do think there's possible external factors that could help it be an opportunity in the future. For instance, one thing I like to say here is that with silver, even if people said it has no monetary values, I don't like it in coins, I'm not going to stack it, it's still going to have that huge industrial demand in the future. So I almost feel like in a sense it's safer as long as you don't buy at the top. You get what I'm saying? What's your thoughts with that thought process?
Look, silver is a quasi-industrial, quasi-precious metal, right? It has like 5,000 utilities. It's used in thousands and thousands of products, and obviously it's part of this green tech future, right? It's
even yoga pants. Don't forget, it's even used in yoga pants.
Okay, so here's two things that are cool about silver. One, your laptop, your computer, your smartphone, etc. They all use very small doses of silver, and so the bears tell you that look, because it's industrial, it's always going to be negotiated down. Like Apple will not be willing to pay $50 an ounce, and Tesla, etc. That's bullshit, because this wouldn't matter if silver goes to $50 an ounce or $60 an ounce. Apple doesn't look at their iPhone and say, "Oh my God, the price of to manufacture this iPhone has just risen by 10%. We have to pass that cost to the consumer." These are such small amounts that they mean nothing to most products on the market that use silver. So that argument is not valid. There's no reason why silver cannot go to 50 and 60. It clearly has the potential to do that. And we've seen other industrial metals and base metals go on epic runs: zinc, copper, cobalt, lithium. These things can really fly. I think for silver, what's really held it back for the past 8 years is that the dollar has been so strong compared to other fiat currencies. If you look at what's called the DXY, and I suggest all your viewers go and check that out. The DXY index is basically an index that weighs the dollar compared to other fiat currencies. And when that index is above 90, silver is weak because silver correlates with the dollar. It doesn't correlate as much with negative interest rates, and it doesn't correlate that much with gold. I mean, we've seen gold explode and silver doing nothing, right? We've seen the gold silver ratio under Trump go to 123-1, right?
That was crazy. That was crazy.
Yeah. So, the correlation is with the dollar. The dollar is weak equals that silver rallies. And so the DXY is the most important thing. In March 2020, the DXY peaked. I don't know if you can show it on the screen or edit it later, but anyways, because of what happened in the March 2020 madness, where people sold not only stocks and went to bonds. That's what they do traditionally, right? You sell stocks, you go to bonds. That's what happened in 2008 in the dot-com bubble in 1987. People sell stocks, they buy bonds because of safety. In 2020, it got so bad that people sold stocks and bonds. They literally said, I want cash. Give me cash.
Right.
Okay, so $30 trillion in equities went to cash. The demand for the dollar was huge, huge. And that's why silver collapsed to $12 an ounce, because everybody wanted the dollar. And that is really bad for silver. But it also made the dollar peak. And if you look at the DXY, since 2013, when it had its breakout, and went all the way up from 70 at the low to 123, 130 at the high, it's now around that 93 mark. So it is literally within 4 to 5% of going where silver becomes magical. Because if it dips below 90, meaningfully, all these same algorithms start shorting the dollar because they know what's coming. They know that the resistance, the support, the 6-year support is breaking. And we've already tested the 90-point limit on the DXY 4 times in the past year, and it failed. So look, if the dollar now breaches below that support, the next time it hits 90, that's so powerful for silver. But if you're looking at this from a trading perspective, I would say 2 things together would be the ultimate buy alert. And that's how we're going to trade it in Wealth Research with our own alerts to the subscribers of the free newsletter. So when the dollar hits 90, we're going to look for a confirmation that it goes to 88, and then we want to see silver going to 29.5. If you look at silver on a technical analysis basis, it's created a $7 range between 22.5 as the support, 29.5 as the resistance. It's a $7 range. The size of the range is the size of the breakout. So in other words, if it's able to breach 29.5, it goes to 36 very quickly. And so a dollar weakness coupled with silver hitting that 29.5, to me, a massive buying opportunity. Now, some people will say, well, look, if you think that's going to happen, then buy now. There's more upside. No, I'm not saying that will happen. I'm saying if those 2 conditions happen,
Right.
then the probability of it goes higher. And so that's my game with silver. I like to accumulate gold because it compounds at about 6.5% over time, and I like to trade silver when there are manias, because as you know, silver manias are like nothing else.
I'm ready for the magic. I'm ready for the magic, Leor.
Exactly. On the options market, on silver miners, when this thing happens, I got a whole watch list ready of things that I'm going to do, and we talk about them on our newsletter, etc. There are things that I'm preparing for. But I'm not gonna speculate that they will happen. I rather them happen, and then I take less risk, less upside. 100%. I'm by definition, I'm gonna earn less if these things happen than if I bet on them now and they do happen.
Right.
But to me, it's not about the reward; it's about the risk-adjusted reward, and I like it much better when I can make X% and take Y risk than make X.5% and take 5Y risk. So that's at least my thought into this. To me, gold, no risk. Literally, owning gold has no risk attached to it over the long term.
Right.
Buy gold. Whenever it dips, buy gold. Up to what point? Either 2 years worth of your savings or 5% of your net worth, whatever is bigger. Because sometimes you get to that 24-month level, you own 2 years worth of living expenses, but then you say to yourself, well, I know I actually don't own as much gold as I should buy. Maybe I should up it to 5% of my net worth, right? Just depends where you are in your life. And then with silver, more of a, I want in, I want out, I'll take the gains, put in more gold because there's no risk there.
So, and I'm not going to hold this to you, but if 1 year from now, what do you think gold and silver will be at in terms of spot price? What do you think it'd be a year from now?
So, and that comes back to my whole point. Why speculate on where they would be? Because it depends on bonds and inflation, right? So if the Fed takes in September the route that they're going to start tightening and gold collapses, well, you've got either 2 years worth of your life savings in there, or 5% of your net worth. So the rest of the 95%, not correlated with that at all, they're going to do well in stocks and real estate, etc. Why speculate? You know what I mean?
Because that's what the viewers want, Leor.
If the consumer, sorry, if the retail public wants to accumulate gold for the long term, then a lower price for gold, fantastic, right? You're taking no risk anyways. It's no risk at 2,000. It's no risk at as long as you have a long-term view of it.
Exactly.
If you own it for 30 to 40 years into the future, and then you give it to your children when they, as long as that's your position, that I own gold. I'm not trading gold. I own gold. Then under this monetary system, gold is important. If tomorrow the Chinese, that's why, like when they ask me 1 year into the future, I mean, that's why ask me? That's why we run a newsletter, because reality changes all the time, and we change with it. Why fall in love with a script? You know what I mean? Why fall in love with something you build in your head? You need to live and breathe the markets. If something happens, you adjust. Okay. So, in my opinion, the best way to look at this is from this perspective. Gold is something that I will never sell. I see no reason to sell gold. Gold is purchasing power. Why would I sell my purchasing power to somebody else, right? I can sell other things that equities, for example, real estate, they appreciate because something has happened. I added value, and therefore I want to sell that value to somebody else. Gold is an ounce. There is no value in gold. It doesn't magically become 1.1 ounces. It's fixed amount of weight that preserves purchasing power. If I bought, and if you go, for example, if you go to our website, you can see what I invest in. Our top menu on the website, there's a button there that says watch lists. This is all of the stocks that I invest in personally, right there. You can literally download and see. So these things I buy, later on I sell. If I believe that the value has been added and that the market anticipates this company having great margins and whatnot, I might take some off the table and whatnot. This is something else. This is equities, or same thing in real estate, right? If you buy something, you fix it up, etc., you sell it. You don't have to, but it's a strategy. Gold, I don't see it as the same thing. I see it as something that I buy and never sell. With silver, I do think that under this type of monetary system, it's much more volatile, and therefore I like to trade it. But if China tomorrow morning wakes up and says, you know what, we want to be like in the West, the yuan, the renminbi, I know you think we manipulate it, we fix it, we do all. we want you to give us a list of dictates and we will take our currency to the next level. Well, if that happens, if the Chinese wake up and do that, the Indians, the Australians, many parts of Europe, the Indians, the Indonesians, the Russians, all these, and obviously the Africans, they will all start to trim down on their US dollar reserves and start buying the yuan, which only makes up about 1.5% of global currency reserves, whereas the dollar is 60%. So, if this happens tomorrow, it's game over for the dollar, because obviously the United States makes up 4% of the world's population. It's not where the trend is, right? The trend is moving to, okay. So, or if central banks wake up tomorrow and say, look, we're going to start buying Bitcoin, and we're going to start reserving Bitcoin in our assets, that's going to change it for the dollar as well. So, I try to live the markets. I try to see what happens and then react to where opportunities arise. But some things hold true all the time. And what's holding true right now under this monetary system is that gold rises perpetually. It may fall, but on the longer term, you create more currency units, the price of gold rises. If you go to officialdata.org, it's a great website that tracks these things. You just put any amount of dollars in the year, and it tells you how much those dollars are worth right now. For example, if you $100 in the year 2000 are worth $63 right now. So saving in dollars for the past 20 years has cost you a tax of 37%.
I call it the hidden tax. It's really the hidden tax.
Yeah. It's embarrassing, and obviously, if most of your income comes from a salary, it's the worst, right? Because if you have a retirement account, you own a piece of the S&P 500, then companies are inflation adjusting their prices, everything, so they rise while inflation happens. But cash doesn't. Cash isn't inflation adjusted. You're literally losing in real terms. And so that's basically my point. Under this monetary system, there are a few truisms that you should stick with, and you don't need to get smart, sophisticated about it. These are things that work. They absolutely work. 50 years is a pretty long time to look if something works or not. So yeah, I have no answer where it will be next year. It depends on what the Fed will do and what a gazillion other things will do. I know that if it's less than 5% of my net worth, then I'll be buying gold. That's something that I know. So if I am personally getting wealthier, I'll keep buying gold. If it's $2,000, if it's $1,000, the only time I would not buy it is when every news stream, CNBC and whatnot, like in 2011. No, I will not buy it back then, because obviously you're in a speculative bubble. But unless every person that doesn't know the first thing about gold tells you should buy gold, then we're good.
You hit a point that I say all the time. If you're getting into metals, gold and silver, and I'm really bullish on silver for a bunch of reasons, but I'm also really hardcore into gold as well. But I say be prepared to hold for the long term, right? If you're putting some money in this, or some fiat currency, I should say, in this that you might need to pull back out, that's when you lose. So if you're getting into metals, you need to be prepared to hold it for the winter, and it might be a nuclear winter, but eventually, you're going to have those ebbs and flows in the market. But when talking about the market, quick question for you. So if folks have been physically stacking and they've never really gotten into the market in terms of like mining stocks, etc., like what's your advice there? How could somebody who's kind of new to that and they do want to get some exposure to silver and gold in the market, like what's your advice there in terms of like mining stocks, etc.?
So not an advice, right? But I can tell you what I like to do, etc. Everybody needs to do their own work, etc., etc. Okay, so within the mining space, there's a subcategory called the royalty companies, and the royalty companies have performed amazingly over time. The big three are called Franco-Nevada, Royal Gold, and Silver Wheaton. This is not a buy recommendation. I'm not giving you a buy recommendation, but I'm telling you, if you look at those companies and look at their price charts over time, especially Franco-Nevada and Royal Gold, which are purely royalty companies, they have done tremendously well. They've beaten the S&P 500, the NASDAQ, and the Dow. They're index-beating companies. And so the royalty business model, and there are obviously smaller royalty companies. It's not like there's two, there's many. It is working. That model is a successful business model within the mining space. All the other companies, most of them, fall into other categories. And I love that question because that's the special report that I've devoted the most amount of time to is this one. If the wealthresearchgroup.com/gold playbook is literally the most comprehensive manual on gold investing and how to get into all these subcategories that I've ever published. So literally everything I'm telling you in 2 minutes, you can download from that PDF report and just, with a cup of coffee, take your own time and go through it. The royalty model is the most effective model. Then there are other models in the mining community. One of them is called optionality plays. These are companies that literally buy big deposits of whatever metal and do nothing with it. They don't explore, they don't drill, they do nothing. They literally sit on a ground where below the ground there's proven amounts of gold because somebody else previously drilled it and proved it, but they're just waiting for the price to rise. Obviously, the price of gold rising means the value of what's beneath the ground rises. But as a company, you have no expenses. You bought that thing and you wait. And those companies do amazingly well as well when the price rises because they're leveraged to the price of gold. And then you got the three classic categories, which are the operating miners. These are companies that mine gold. Obviously, they need to cut expenses all the time and manage their costs so that their profit margin rises because they can't control the price of gold. They can control the price it costs them to produce the gold. There are the developers, which are creating value by getting projects into production. And then there are the explorers. The explorers literally drill the ground and perhaps they'll find something, perhaps they won't. So they're obviously the highest risk of them all.
I was going to ask you, so explorers are the highest risk, but also maybe the highest return, you think?
Yes, with no doubt. I've been involved with some we highlighted a company in July 2020 that went up, for example, 900% up until today. So 1 year, 900%, that's pretty good. And it literally, all it did is do more drill results, just announce more drill results, because if you can prove that this dirt is full of gold and other metals, I mean, it changes the whole value of the company. You buy a piece of land for a few $1 million, and now you have a few $1 billion worth of gold in there. It dramatically changes the value of the company. Now, it's not that the developers and the miners do not explore. They do. When you own a mine, you continue to drill and look to expand the mine life and whatnot. It's just that if something was bought for $1 million and then you found $500 million worth of gold there, that's gonna impact the stock price way more than if you have $1 billion mine and you found that you have another 100 million in gold in there, right? Okay, so I would say general rules of thumb that I use is no more than 15% of your portfolio in general, not of your net worth, of your portfolio, right? So because you should have not just stocks, you should have other asset classes that you're investing in. But of your portfolio, I would say no more than 15% in commodities. That's at least my rule. And then within that, I would definitely stick a lot in the royalty companies. Do your research the ones that you like best and the prices that you believe are the best value, etc. Royalty companies have done the best, and there are ETFs to track royalty companies. And then look at the other ones. But here are a few important things. I would call every company that you want to invest in. I would call the company, ask to speak with the CEO or the CFO or investor relations. I would speak with the company before I put a dime in there. I want to know who owns the shares. Okay, if the management company has a lot of skin in the game, at least 25% or up. If not, red flag, because who owns this company then? I want to make sure that the operators, because these companies have 5 to 15 employees. Okay, so are the directors incentivized only with options, etc.? Are everyone making a big salary using my money, or are they incentivized to actually build value and get compensated in stock? What is the strategy? What exactly do you want to do? How much are you spending on doing that? Just ask a lot of questions, and it's not just the answers. It's that instinct. What are you listening to? Who is this something that's reliable or not? And obviously, you can pre-filter the whole thing by only looking at companies whose management teams have already been successful. That it's not their first rodeo. People that have been serially building good mining companies, and there are these groups of people that this is like their fourth $4 billion company. That's a good sign, right? People that are experts at selling companies to the majors, like the Barricks, the Newmonts. Very important, because most of these small companies, what they want to do is get bought out. And then look at the jurisdictions as well. That's a really important point.
Yeah, that could be risky if it's in like a place where maybe the government takes it over or something, right?
Absolutely. Not only takes it over, but just think about a worker strike, or a change in tax regime. For example, it gone from 20 to now 45. Right. For mining, it kills the project. The whole economics are gone. Or there's no roads, and the government, doesn't promise anything. Right. Okay. Or no power, power infrastructure or water treatment. The whole thing. Or they're not they're environmentally too friendly. Like they have too many regulations. Okay, so you got that. And then at the end of the day, I like to use two rules. One is the 2% rule. So I will never invest more than 2% of the portfolio in one company. And I will always put a 50% stop loss. So if I got the whole thing wrong and it just didn't work out, it's a loser, then that 50% makes sure that I only lost 1% of my portfolio, because I put 2% in max, lost 50% of that. So that's 1% of my overall portfolio. If I have $100,000, then $1,000 have evaporized, and I've donated them to the market, right? But on the flip side, the upside was turning 2,000 into $10,000 to $15,000. So I took a 8-to-1 risk reward ratio. I can live with that, and I didn't make it. But here's the thing: if you only do those and one of them pins out, then it clears out. Okay, so you let the winners ride, and you cut these losers fast. Don't fall in love with these companies.
Don't get too committed. Yeah, I like that.
Don't get committed at all. I just do your own recipe. You can do 3% and 33% stop loss. That still comes out to 1%, right? Or 4% and 25% stop loss. That still comes out to 1%. Control the downside is basically my point.
And I know we're short on time. I know you got to run, but I have one more question. So if the market was going to crash, or we knew like a market crash was coming, like what's the safest place to put your fiat currency or your money? Like would you still leave it in the different, stocks you have, and or would you pull it out and put it in metals? Like what's the safest place to park your cash if you really truly believe a major market correction's inbound?
So could you define a major? Because that's basically going to define
like
my
what we
answer.
saw in like 2008, you know what I mean? What we saw
Yeah.
when the circuit breakers were getting hit and all the madness.
Okay, so it's really easy. If you're not 60 and above, so if you're not thinking that your retirement portfolio, if you don't need that money, then what's the problem? 2008 happened. This is not a popular answer. It's a very contrarian answer. But think about what I'm saying. In 2008, you saw a 47% crash. By 2011, the markets were at all-time highs.
So if you just wrote it out, I see what you're saying.
Later, right?
Yeah, just write it out.
I'm not saying just write it out, but I'm just to give you the preface here. 2 years, and you got back. The Nasdaq was extremely overvalued in 2000, right? And it took it 14 years to come back. So there you have the most epic bubble ever in the Nasdaq. It took 14 years. So now you're thinking to yourself, okay, if I'm 50 and above, I should think about my Nasdaq portfolio, because that can take 14 years to come back if it's an epic bubble. But for example, the circuit breakers, by August, we were in all-time highs. By August 2020, the markets came back all that 35% and hit all-time highs. So my answer to you is, if you're not in any need to pull that money out from living expenses in the next 5 to 7 years, your strategy should be, I need to buy dips. That's your strategy. As long as the whole dynamics doesn't change. In other words, if there's a reset, not of the stock market, but of our way of life, that's something else. If there's a world war, but if you're asking me just whether or not I think the markets are overvalued, and because of that we will see a big decline, well, I just had a real good case study of what happens when globalization peaks. That's a pretty big deal. The markets came back 35%. That's about 3 or 4 years. The market pulled back like 3 or 4 years. So if the worst case scenario is that I lose 3 or 4 years worth of gains, then it's not worth my time to try to time in and out of the markets. It's way more advantageous to me to have a lot of cash coming in from my businesses or whatnot, so I can buy more. That's way more important than for me to try to time it. But there are positions that I would definitely close immediately if I see a big crash coming. All of the small caps companies,
right,
that are either pre-earnings, so they're just developing something, I would just destroy them. I will not hold them in a correction, in a big correction. But companies that I bought for the right price 6, 7, 8, 10 years ago, I'm not going to sell because of a big market correction. If I bought a company like Amazon, for example, if I bought Amazon like 10 years ago, so what if the market pulls back? What does it have to do with me? I own a piece of one of the most important companies on planet Earth. It's growing at 20% a year still, and so in 10 years it will be much more valuable, as long as everything continues to rock for it. So the answer is, I would be much more concerned with creating a watch list of companies that I want to buy in that kind of environment than which companies I need to sell.
Well, that makes perfect sense. And I love how you break things down. And I think the viewers are going to love it too. Where can they find you? I mean, I know you dropped your website a few times, and after this interview, that's the first place I'm going to check out your reports. But where can folks find you and learn more about what you do and what you do personally?
Yeah, wealthresearchgroup.com. It's the website, and you can subscribe to the free newsletter right there on the homepage. I think that the newsletter is basically how I share my life and my what I'm thinking with the readers. On the top menu, you will see two tabs that I think are more important. One is called Special Reports. It's like a wealth library of PDF downloads that you can kind of pick and choose from. And the one right next to it says Watch Lists. Those are basically all the companies that I have invested in or am investing in or looking to invest in, because each company has research there right next to it. And then it has like a proposed limit price of where I'd like to buy it. Some of them you wait for a year. Some of them you wait 2 months. I wait for a particular price in order to get in. And next week, actually, if you're subscribing to the newsletter, just know that next week I'm upgrading that watch list tab, and it's actually going to be called Live Portfolio, and you can literally just see my portfolio all the time. So that's pretty cool, and I think that gives you a lot of access into what I'm doing.
That's super cool. I'm definitely going to check that out. I'm just going to copy you exactly. I'm going to know.
Copy. I don't think it will jack up the price of those companies.
We're gonna run it to the moon. Oh, Dogecoin. Is Dogecoin going to the moon, Leor? Is Dogecoin going to the moon?
I think I'll get to the moon before Dogecoin does.
That's funny. Well, hey, I really appreciate it. I know the viewers loved it. This has been a great conversation. Are there any final words you want to say to folks?
No, just keep stacking, I guess, right? Is what you say in the community.
Well, I guess that's the end of the interview. So what do we got to say, Leor?
Catch you in the next one.
Catch you on the next one. Woo!
One stacker.